Hello and welcome to the monthly market report for February 2022. My name is Kate Rezebek, and today David Childers and I are going to be walking you through three of the most important topics in the housing market right now. We'll be talking about home ownership as a hedge against inflation, rising mortgage rates, and the latest update that we have on forbearance. So I'm going to begin with the first topic, home ownership as a hedge against inflation. Now, why is this important for us to be talking about? Well, as we see prices rise around us at the gas pump, at the grocery store, home ownership is certainly not immune to that in any way. And, neither is rising rent. We're going to talk about that as well. But one of the things we want to focus on is how locking in someone's fixed monthly cost, their biggest cost that they have in home ownership at today's price, is so beneficial to safeguarding someone or hedging against that inflation and that rising cost around us going forward. So I want to begin with a quote first from here we go, Investopedia. It says, real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So what we can see here is that home ownership is one of those things that you can lock in the cost today. It's an asset that's increasing in value in time. And as prices rise and home values rise and all the prices around us rise, locking in that fixed cost in home ownership is really game changing as a hedge against inflation tomorrow. So what I want to do on this next slide is show you a visual that really depicts what we're talking about as home ownership outperforming inflation over time. So let's take a look at this slide here. This is home ownership as a hedge against inflation. And I want to break it down for you so you can really see what we're talking about here. This is home price appreciation versus the consumer price increases over the decades. And it goes all the way back to the 1970s. Now, what you're looking at here is the blue bars are the average inflation rate for the decade, and the green bars are the average home price appreciation for each of those decades as well. So let's look at the 1970s to start. Inflation increased at 7.1% in that decade, and home values appreciated at 9.9% in the same time period. So home ownership outperformed inflation. And where do you want to be in inflationary times? In that asset that's outperforming inflation. Now, in the 1980s, it was a little bit more balanced, 5.6% inflation, 5.5% home price appreciation. And look at the 90s, we start to see home values tick up again a little bit more, outperforming inflation throughout that decade. Now, we know the 2000s were very different. Home prices, performed at a very different rate than what we've seen in many other decades and even what we're seeing today and potentially tomorrow. So we also had a fundamentally different housing market. We had the oversupply of homes. We had, lending standards that were vastly different than they are today. Homeowners didn't have the equity that they have in their homes right now. So fundamentally a different market where, we're not headed going forward. So home prices did not outperform inflation in the 2000s. But look at the 2010s. This is where home values really started to kick in. Homes started appreciating much faster than inflation, 4.9% versus 1.8. And then 2020 and 2021, what's happened here. Massive home price appreciation, a drastic difference where home values outperformed inflation. So over time, what you can see is that home ownership is generally looked at this great hedge against inflation because home values are performing better than the inflation rate. And that means that someone buying a home today can lock in today's cost and protect themselves against the rising cost of inflation and that biggest monthly payment going forward. Now, this becomes really important when we start to talk about renting, because renting takes on the risk of rising rental prices year after year after year. And we've shown you that data if you've been following along with us, how rental prices are truly skyrocketing. So let me share a quote with you here that's really powerful for renters. It says, this is from Bankrate, and it says, a fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same. That's certainly not the case if you're renting. And that's because rental prices rise year after year. And so this becomes really powerful for someone who might be sitting here going, I could buy today, but I'm going to kind of press pause and I'm going to wait. I'm going to wait and see what happens to home values, if they drop, if they rise. Well, all the forecasts that we've seen show that home values are projected to continue rising. We also know that mortgage rates are projected to keep rising. And we know that rental prices are rising. So, what does that mean at the end of the day? Someone who continues to rent but could buy is taking on the additional increases in rent year after year. Plus, it's going to cost more to buy a home down the road. So, really important for renters to understand this dynamic. And I think this next visual really helps show how rental prices compare to inflation rate. So, this shows that rent increase has been greater than inflation in most years. So, let me break it down again. Rental price appreciation versus core inflation rate, again, going all the way back to the 70s. So your blue line is that core inflation rate, and your green line is rental price appreciation. And what do we see on a whole? The green line higher than the blue line in most scenarios, meaning that rental prices have increased at a faster rate than inflation in most times. Yes, there's some ticks down below that blue line. However, that means it's more expensive to rent over time because rental prices are continuing to rise faster than the rate of inflation. So when we have this conversation with renters, it becomes mission critical that they understand the dynamic of buying now if they can to avoid those increasing costs from rent and inflation all around us. So let me go ahead and share this quote. I think this really kind of brings it home for us. It says, this is from Forbes. Homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what's happening in the market. They're locking in that payment at today's cost. Tangible assets like real estate get more valuable over time. You've seen that in the graphs and the data that we've shown you, which makes buying a home a good way to spend your money during inflationary times. And, we've talked a lot about home price appreciation, and I'm sure you want to know, where is that headed as we have this conversation and we think about rising prices and how homes aren't immune to that. That's for certain. So let's take a look at this next graph from the Home Price Expectation Survey. And I think this gives you a real clear picture of where home prices are projected to head according to the experts. Now, the Home Price Expectation Survey is a survey of 100 economists, data analysts, people who are projecting out home price appreciation. And in the fourth quarter of last year, this is the projection for cumulative house appreciation by 2026. So what are you looking at? They divided out the group into optimists and pessimists, optimists being the ones projecting the most appreciation over the next 5 years, and pessimists estimating on the lower side. So take a look at that orange bar. Those are the pessimists, the experts that are saying home price appreciation on the lower side, cumulatively by 2026 is going to be over 23%. So as experts look forward, the conditions of the market, what's projected to happen, home values are expected to increase in value over time. Even on the lower end, 23%, 23.7 is pretty significant over the next 5 years. So locking in today's costs is mission critical for those who have the opportunity to do so, to protect themselves in their largest monthly payment. Because as we know, with home prices rising, mortgage rates rising, inflation all around us, it's going to get more expensive to purchase a home. So I'm going to pause here and I'm going to send it over to David, who's going to walk you through an update on mortgage rates.
All right, thanks, Kate. Let's talk a little bit about mortgage rates. Here we are at the beginning of February, and certainly we've seen a rise in mortgage rates in a volatile environment. So I'm going to cover where we're at today, but certainly as we go through the month, we're going to keep you updated on what's happening with mortgage rates. So let's start right here. Sam Cater from Freddie Mac says mortgage rates remained unchanged from last week. The economy lost some momentum in January, leaving mortgage rates unchanged from last week and relatively flat for a third consecutive week. This stagnation reflects the economic impact of the Omicron variant of COVID-19, which we believe will subside in the coming months. As economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that homebuyer demand continues to be elevated as supply remains low, driving higher home prices. This statement came out the day before the jobs report on Friday, right after it. And certainly, I think a positive jobs report hints to the Fed taking action and raising the Fed funds rate in March. Expect to see rates go up. We're at about 3.55% on the average 30-year fixed is recorded by Freddie Mac, but no doubt a volatile January leading into a February that I believe will see more rise in rates. And that's what we need to be prepared for. So my goal over the next few minutes is to give you what you need to accurately communicate that. So if we look at this rise in rates, we're at about 3.55%. This graphic goes back to the beginning of 2020, and we're starting to get back in the area. We're back in the area of where we started when the pandemic came on us in March of 2020. Just to put that into perspective, the Fed comes in and acts. They influence, they don't control mortgage rates, but they influence the rates down, and now we're back coming back up. Certainly a sign that we can all hope for, that the economy is improving, that we're getting through this and we're moving ahead. That would be my word for it. You know, if you take a little bit larger look, if you go back to the beginning of 2018, which is what this graphic shows on the average 30-year fixed, and sort of make this line of 3.55%, you can see where we sit there. Rates certainly were higher back in 2018 and 19, started to come down and certainly drop to historic lows during the pandemic. And we're starting to come back out of that. You know, perspective on that, again, from Freddie Mac is mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. No doubt we'll see a housing market that is competitive this year. Goes on to say in 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, while refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. Why is this important? Look at the two mortgage markets. You have the purchase market, you have the refinance market. Purchase market forecasted to grow, refinance market forecasted to constrict. And that makes sense, right? In a rising rate environment, everybody had the chance, maybe not everybody, there still will be refinances, but most people refinanced at a record low rate, and good for them as homeowners to be able to do that. But we're going to see volume constrict. Why is this important right now? Your customers, the people you're working with, are going to see headlines that talk about the overall mortgage market constricting. You know, the hyper state of awareness, when you're thinking about doing something, you start to recognize every article and every headline that's out there. We need to be the educators in this topic. Purchase market's going to grow. Refinance market is going to constrict. Let's keep that in a perspective as we go into the year. And not just the reminder that, you know, hey, I know that, I realize that, but to be vocal about that and remind your customers about that because they don't know that. You know, if you take this rate of 3.55% and even going into 4%, which I think we'll see very soon, that's still a very, very favorable rate when you go back all the way to the 70s. This is the average 30-year fixed by decade going 1970, 80, 90, 2000s, 2010. And what do you see there? At 3.55% or even at 4%, very, very favorable financing when we look historically. You know, I've mentioned it before, between 2010 and 2020, we bounced around 3.5% to 5%. It was really the range of interest rates during that time. You see the average rate here of 2010 of that decade, 4.09%. Very, very good financing. So it's going to feel like we're heading higher, but when we look historically, still very, very good financing for homes across the country. So the last two slides that I want to show you really kind of position what we need to be as the educators around interest rates in this market. You know, many are asked about interest rates and they may not have an opinion on it and say, well, gosh, they're going to go higher and we're just going to have to wait and see. You can be the educator. And here's what you need to be looking at for the rate conversation. It's the 10-year Treasury yield. This is a look at the 10-year Treasury going back to the beginning of December, just 2 months ago. And what do we know? During that time, the rate on the 10-year Treasury yield has skyrocketed, knocking on the door right now of 2%. Why is this so important? Here's why it's important. For the last 50 years, the relationship between the mortgage rate and the 10-year Treasury yield has been almost symbiotic. Okay, wherever the 10-year Treasury yield goes, there goes the 30-year fixed rate. Okay, the Fed raising rates does not control interest rates. They can only hope to influence it. What we want to watch is the 10-year Treasury yield. Okay, so I would have that conversation and maybe even use these graphics to say what I'm watching is the 10-year Treasury. Why is that? Because the past 50 years, there's been a relationship between the 10-year Treasury and the 30-year fixed. I'm staying on top of this. Even to take this a step further, what I would do is I would look at where we started the year at about 3.1%, where we're at right now at about 3.5%, and where we're going at 4%. And I'm not saying we're going to stop at 4. I don't have a crystal ball, but that's certainly the outlook. And I would take the average loan amount in your area. Maybe you get this from your lender partner or have them do the calculation. What was the payment at the beginning of the year? What's the payment now? And what's the payment at 4%? It's going to show people the real impact of moving interest rates. And certainly don't want to convince anybody to do anything they don't want to do, but we want them to be educated on what's happening in the market. I'll end on this slide here before I turn it back over to Kate. Mortgage rates hit their highest level since March 2020. Leading to the slowest pace of refinance activity in over 2 years. The market in the last couple of years, the mortgage market certainly has had a ton of refinances in it. Those are going away. And my advice to you is to have great partnerships, lender, agent, and really serve the client the best way possible going forward. So I'll wrap on that and I'll turn it back over to Kate.
All right. Thank you, David. Now, the next topic, the last one we're going to walk through today, is our latest update on forbearance. And this is something we've been following along with for a while and sharing with you. And I think today's data is really going to help articulate why we will not see a wave of foreclosures coming to the market. Now, I want to begin today with an update on how many loans are in the forbearance program. Take a look at this graph right here. You've seen this with us before. Loans in forbearance have fallen below 1 million. This is massive. We're at roughly 780,000 loans in forbearance today, and that equates to only about 1.4% of mortgages. If you think about where we started over there in the red bars on the left, there were nearly 5 million homes in the forbearance plan in May of 2020, and we're down to about 780,000. So huge progress. And just one more way that shows that the forbearance program has really helped homeowners change their situation, stay in their homes, and really be in a better place than they would have been in such a time of economic uncertainty. And this is vastly different than what we saw in 2008. So I want to share a quote with you from Black Knight that says, "As the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans." So many people, 89% of the people who went into the forbearance plan have exited, and that is massive, massive improvement. And what I want to share today is a graph that you've probably seen with us before, but this is loans upon exiting the forbearance program. And I want to break this down because this really walks you through what's happening as people are exiting the program today. So take a look at the green section. Let's start there. 38.1% of homeowners exiting the forbearance plan are paid in full. So they've made their monthly payments or they paid off their loan. They've done something to bring their payments current, and they're in a great place. They're walking away, no issue. Now, 43.7% are workouts or repayment plans. That's the section in blue. This is the game-changing section. This is the section we didn't have the last time around when the housing bubble burst, because these are the homeowners who have been able to make a modification, a loan deferral, to go back to their bank and work with their bank or their lender to change their situation and stay in their homes. This is huge. And what we've been saying over time is this blue section is getting a little bit bigger than the green section. And that's because more and more people have been able to go back and work out an alternate plan. That is massive. Now, the percentage of homeowners that are still in trouble are in the orange section, 18.2%. But what this does mean is that these homeowners are exiting the plan without a loss mitigation plan. But on the same side, what we know from Black Knight is that 93% of homeowners in the forbearance plan have at least 10% equity. So when you have that equity, you also have the opportunity to potentially sell your home rather than go into forbearance. So people sitting in this situation, 10% is kind of that tipping point of you could sell your house, you could pay off your fees, you could, maybe even walk away with a little cash in your pocket. If you sell your home. And so that gives someone a different opportunity than going into forbearance. And we have a very strong equity situation across the country right now, enabling that opportunity. So as we look at this graph and we think about how many homeowners are exiting the plan, what's happening, the reality is that about 4 out of 5 homeowners are walking away just fine. Now, where I want to bring some additional context to this is in what the forbearance situation or what the foreclosure situation looks like in a typical year in the US, because I think this really is going to start to shape up what we're talking about today versus what we had in 2008. And, let me remind you, we've shared with you the quote many times on how 9.3 million homes went into foreclosure the last time around when the housing bubble burst. And we're in a really different situation now. So remember that 9.3 million as I walk you through this next slide. What this says here is that 422,360 fewer foreclosures over the last year. So we have significantly fewer foreclosures today than we would even in a normal year. Let me break it down for you. So look at those first 3 red bars, the taller ones on the left. That's 2017, 2018, and 2019. The number of foreclosures we had in those normal years leading up to the pandemic averaged just under 300,000. And so the unfortunate reality is that in this country, every year there are homeowners who do go into the foreclosure process. They have a job loss or a challenging financial situation, something happens where homeowners have to give their homes back to their bank or their lender. In 2017 through 2019, that number averaged out to about 290,000. Now, if you look at 2020 and 2021, these were not normal years. This is where the forbearance program came into play, and there were far fewer foreclosures in each of those years. So if you look at the red bar under 2020, there were 129,000 foreclosures in 2020. That was short 161,000 of what would be normal. 2021 through the third quarter is what we have data for right now, 29,000. So massively short. So that's where that 422,360 number comes from. And contextually, if you think about that, that is incredibly low. In fact, it is so low, I think this next graph really shows it well. Foreclosure activity is actually at an all-time low. So look at the number over on the right side of the screen, 2021. Where we are so far, there are 151,000 foreclosure filings. Now, we never want any one homeowner to go through the foreclosure process. We certainly don't want that to happen. We believe in home ownership and the value that that brings everyone. But if you put this into context and you look at those red bars, 2007 to 2015, millions of homeowners were going into the foreclosure process. And that is vastly different from where we are today. I mean, even in this number of 151,000, if it doubles, if it triples, if it quadruples, keeps going, we're nowhere near where we were when the housing bubble burst. And this is massively impactful, showing that the fundamentals of today's market are just very, very different today. Now, I want to end with this quote because I think it really kind of brings it home. This is from CoreLogic, and it says, "We may see a little bit of an uptick in foreclosure rates in 2022. Just an uptick, though, from an extraordinary low level. We're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low." And that's exactly where we are today. the number of homes going into the foreclosure process, nothing like we saw in the housing crisis, thanks to the forbearance program that gave homeowners the mortgage relief that they needed when they needed it most. So I'm going to end right here. Thank you so much for joining us for the monthly market report. I have one quick update for you. We have our spring buyer and seller guides coming out on March 4th, 2022. Fantastic resources to share with hyper relevant information, all the latest you need to get the message out for buyers and sellers to feel successful in this spring market. Thank you for joining us today. I hope these visuals were powerful. I hope you download the guides when they do come out in March, and we'll see you next time.